the ultimate destination for smart investing. Welcome to Invest Ideas, where we turn your financial dreams into reality. Subscribe now and join us on the path to financial freedom. Hey there, let's talk about the first half of this year and what happened to your retirement savings and investments. It's not a pretty picture, unfortunately. Equities have taken a significant hit, and even bonds, which are supposed to be a risk mitigator, have been hit hard. Returns have been negative, correlations have been all over the place, and overall, it's been pretty volatile. So it's understandable if you looked at your first half statements and got upset. But let's take a closer look at what's been driving inflation higher in recent times. Energy and food have been major drivers of inflation, but fortunately, they're going to weaken and become less significant. However, the core number is going to stay high, which speaks to an inflation process that has become more interesting and broad-based in our economy. I anticipate a core CPI in the 4.5% to 5.5% range, well above the Fed's 2% target. The collateral damage associated with inflation coming down worries me the most, because the Fed has been so late in responding. When I started noticing this trend about 15 months ago, the Fed was all about the notion of transitory inflation. Had they listened to companies, they would have been more humble in their approach, as companies were warning of supply disruptions and supply chain issues that may not be resolved quickly. The Fed got hooked on this notion of transitory inflation, and it got itself into a cognitive trap where it kept repeating it, even when it was clear that inflation was a problem. The Fed could have done more at that stage, but it ended up tying its hands. In March, it was still pumping in liquidity and doing K when the inflation rate was already at a 7% handle. We have two big dynamics going on right now. One is the demand-supply dynamic, where we've gone from a world of deficient aggregate demand to a world of deficient aggregate supply. This will resolve itself, but we have another phenomenon going on where the nature of globalization is changing. We're going from a focus on efficiency to a focus on resilience, and this transition is, by its nature, inflationary. It's important to ensure that inflation doesn't develop deep roots across many segments of our economy, or we may end up with a low-growth, high-inflation environment for much longer than necessary. I'm critical of central banks, not because I don't believe we need them, but because they have an enormous responsibility and power. Central banks are essential for economic well-being, but they need to function well and be held accountable for their actions. Political autonomy is an incredible thing to have, but it comes with a lot of responsibility. We need honest and transparent communication from our central banks so that we can trust them and their decisions. When the Fed publishes its quarterly projections, people often call it laughable, and former Fed officials complain that we need to get back to a world where the Federal Reserve is credible. That's essential to the well-being of our society. We've all gotten used to measuring things by GDP, and it's hard to get out of that mindset. My definition of a recession is a holistic definition that goes beyond 2 quarters of negative GDP. We're not in a recession yet. The labor market, consumer spending, and business investments are all still strong. However, the risk of a recession is high, and it's getting higher. The Fed is hiking into a slowing economy, and all the major areas of the global economy are slowing down. So, in summary, it's been a tough first half of the year for investments and retirement savings. Inflation is a major concern, and we need to be cautious about the potential long-term impacts if it's not addressed properly. The Fed's delayed response to inflation and their cognitive trap of transitory inflation has limited their ability to act decisively, and the changing nature of globalization is also contributing to the inflationary pressures. Central banks have a crucial role to play in economic well-being, but they need to be held accountable and communicate transparently with the public. It's important to note that we're not currently in a recession, but the risks are high and increasing. The Fed is hiking into a slowing economy, and global economic growth is also slowing down. While we can't control external factors that affect the economy, we can take steps to protect our investments and retirement savings by diversifying our portfolios, considering inflation-protected assets, and staying informed about economic trends. Overall, it's important to stay level-headed during times of volatility and uncertainty in the market. While it can be tempting to panic and make rash decisions, it's crucial to take a long-term view and stay focused on our investment goals. By staying informed and taking a prudent approach to investing, we can weather the storm and emerge with our retirement savings intact. Thanks for tuning in to Invest Ideas, where we bring you the latest insights and strategies to help you make informed investment decisions. Don't forget to hit the subscribe button and stay ahead of the game. Until next time, happy investing.